Good afternoon. This is Robert Rayburn here at Life Pro Asset Management. It is August 7th of 2023. Hope that everyone had a great weekend. Certainly was an interesting week, to say the least, last week, as the U.S. did get downgraded. We are calling them the Biden bonds that got downgraded. Now, to be fair, the downgrade is a result of many administrations' policies, but the current president takes credit for when the economy does well, and any current president, sitting president, gets credit for when things are going well, and they unfortunately do get the opposite end of credit when things don't go their way. So we're calling them those Biden bonds that did get downgraded here last week. Now, we're going to go through what that means, whether it really means much of anything, or if it's much to do about nothing, or if it's something. And so that's what we're going to focus on this week. Rising interest rates, what does that mean for asset allocation? What does that mean for commodities? What does that mean for technology stocks? And how are we positioning portfolios ahead of all that? So let's go ahead, get started. As we talked about, those Biden bonds did get downgraded this week. So, I think the comparison is to look at 2011 and pull out that playbook and say, well, things are going to unfold in the same way. Now, what we're going to show you this week is that it's much different. We're in a different type of trend. We're in a different type of quantitative easing, in other words, quantitative tightening background versus QE. And so we have to think about things a little bit differently. Back then, we were money printing. This time, we're actually pulling money out of the system. Two different types of macroeconomic setups. Number two, oil inventories are now collapsing. So if you remember our update from the last 2 weeks has been that August was going to be this month that we suspected that inventories were going to fall off a cliff. We had the largest draw ever on oil inventories on a week-over-week basis. So we'll go through that. And then lastly, if interest rates do go to 5%, which we think may happen on the long end, so those 10-year interest rates going to 5, currently sitting around 4, which assets may benefit, which assets may struggle? We'll go through that this week. So the debt downgrade. I wanted to show two pictures here. Back in 2011, we were in what we call a structural bull market for bonds. So in other words, yields were heading lower, and it didn't really matter what happened with the debt downgrade. If anything, when the U.S. got downgraded, yields plunged. In other words, bond prices went up. And a lot of this was we were in the era of QE money printing. And right as the U.S. got downgraded, Europe was going through its debt crisis. So people were seeking U.S. dollars for safety. This time around, it's a completely different type of scenario, right? So in 2011, you got QE, you got disinflation, you got low growth, you have a European debt crisis. This time around, you got money supply that's shrinking. The Fed calls that quantitative tightening. You have inflation, and you have a structural bear market in bonds where rates are going higher. So while it's easy to say, hey, this debt downgrade means nothing, it could actually mean something, right? U.S. is fully good for its money. I don't think that's a question, but it does give the bond vigilantes out there a little bit more reason to step up the selling of bonds. So if you were going to sell them once, if certain things that came into place, whether it's inflation reports or whatever, you now have an excuse to sell them because of this downgrade. And when we look at where yields are right now, they crossed into that 4% range. They are impacted by what's happening overseas in Japan and rising interest rates over there. So I think it's just a little bit of a different environment and a different scenario. And you don't have the Fed coming in and buying bonds like they did in 2011. So we think the impact could actually surprise some people with rates kind of moving there to the upside without the Fed stepping in as a buyer of last resort. Now, the other reason why we think interest rates could continue to move higher is this reflation pain trade that we think is developing. We've talked about this for the last month. You see it reflected in our portfolios as we've been shifting assets over to hard assets, stuff that can benefit from rising interest rates, a more cyclical part of the cycle where nominal growth stays high, but inflation is higher. And that's what we call a stagflationary environment. So we see here is gasoline prices after a big drop have started to really accelerate to the upside. What does that mean? Price is up. That's inflationary. That's not deflationary. The big input to our daily lives. Oil drawdown. This was the huge story this week, is that record oil inventory drawdown. Big for a few reasons. That feeds into gasoline prices at some point, right? This is your first step toward higher gasoline prices. Number two, the U.S. has already drawn its emergency reserves, and OPEC came in, Saudi Arabia in particular, said that they're going to extend their 1 million production cut into September. OPEC is putting their foot on the U.S.'s throat right now because they know the U.S. can't respond. And the U.S. burned a lot of geopolitical bridges last year by basically trying to push oil prices lower against the Saudi Arabians, right? And so the Saudis were extremely upset about that. This is their payback. So this is something I think we really just need to pay attention to. We think this is part of a broader, more secular bull market for oil and energy prices across the board, both stateside and overseas in Asia and Europe. And that, again, is reflected in the portfolios across the board. So if you have oil prices going up, you got gasoline prices going up, heating costs, food prices, all that stuff going up, what would your expectations about inflation be? Probably that they're going to go up. And we are starting to see that. So when we look at the five-year forward break-evens, which is a measure of inflation expectations 5 years from now, something that the Fed looks at very closely, something that the bond market and bond investors look at very carefully, has started to break out back to the upside. We had this decompression for many months, and now a sharp reversal higher. Remember, just a couple of weeks ago, everyone was declaring victory over inflation. We believe that marked the bottom for the inflation cycle, and inflation is going to start to reaccelerate back to the upside. Another big reason, Japanese interest rates have skyrocketed over the last week. So for the better part of a decade, the Japanese central bank have been enacting what's called yield curve control, YCC. That has acted as capping the 10-year interest rate at an artificial level. The central bank has started to back away from that. Why? Because Japan's experiencing some of the same inflationary pressures that the US is and that Europe is. So they need to let interest rates rise a little bit to offset some of that. And so when Japanese bonds are no longer anchored, guess what happens? Well, if you're selling Japanese bonds and interest rates go up, that spread between Japan and the US starts to compress, so people start to sell US bonds as well. Well, if Japanese bonds are going up 100 basis points, so should the US. So it has that ripple effect as it relates to what we call relative asset valuation in the bond market, right? So as Japanese rates skyrocket higher, well, the US should do the same to maintain that same interest rate spread between the two countries. This is a big deal. We want to pay attention to that as well. So what are these factors that are impacting bonds vis-a-vis interest rates? International bond interest rates are moving higher. So to maintain a stable spread between those countries and the US interest rate market, US interest rates move higher in conjunction with those bonds. Number two, commodity, food, and gasoline prices are breaking out to the upside. Those are inflationary pressures, a key component of what determines interest rates in the bond market. So that feeds into number three, which are those inflationary expectations. So monetary policy continues to tighten. International bond interest rates are moving higher. That has the ripple effect of moving US rates higher. And then, of course, that reflationary trade fueled by commodities is another big factor driving those prices down, interest rates up. So we believe that all of this stuff will come together to push the 10-year interest rate, not the 2-year, the FOMC policy rate, the 10-year interest rate closer to 5%. We're at 4% right now. So the big question then is, if interest rates move to 5% from 4%, what should we buy? And before we answer that, this chart here, for those that are wondering, this is a technical analysis chart. So when we see any sort of asset class trade in a range, we want to look at how wide is that range, right? So US interest rates have been bouncing around about the low 3s to the 4% range, probably for the better part of a year or so, call it 6 to 8 months. And the range has been about 84 basis points, right? So we're trading in this channel for the better part of 6 to 8 months, and now we're breaking up to the upside. So from a technical analysis perspective, what a technical analyst will do is say, oh, in that 84 basis point range, once you get out of this consolidated box, you can expect a similar move of this range to the breakout to the upside, which gets you to around that 4.93% mark. Now, we think that coincides with where inflation factors are, where FOMC policy is to get that 10-year to 5%. So we get to 5. What works? What doesn't work historically from an asset class perspective? Global energy, metals and mining, banks, and consumer companies with pricing power. Those are the 4 things that we are laser focused on right now. Nothing else is going to distract us. We don't care. Everyone's got an opinion of what should buy or sell. Historically speaking, these are the 4 groups that do well when interest rates start to move higher in a reflationary tape. And additionally, cheap valuations across the board for these sectors. They're cash flow rich, they're underowned, they're maligned, and we think this is a great setup for these sectors. And these are the sectors that we're overweight generally across our equity strategies. And I think you're already starting to see evidence that that rotation has started. So the chart here on the left, this is energy relative to the S&P 500, hit its first 3-month relative high, really since Q4 of 2022. And we look at materials. So this includes chemicals, gold, copper stocks, base metals, those types of areas that we're invested in. Again, you're starting to see a big breakout here. Got hit much more than energy did earlier in the year, and now breaking out to the upside. We think energy and materials are making a serious claim for market leadership here. So how does that look relative to technology and relative to consumer stocks? So technology relative to energy is in clear breakdown mode, and that's before, this chart was made before Friday where Apple sold off close to 5%. Consumer discretionary relative to energy, breaking sharply lower. We believe this is the early innings, ladies and gentlemen. So we think there's a big trade setting up here for commodities to the upside. We want to stay away from technology as long as we can. There will be an opportunity to buy, but it'll be later on in the future. And frankly, when we look at commodities over the last 120 years or so, commodities relative to the Dow are some of the most undervalued prices or valuations that we've ever observed. So we just think that the opportunity or the moment for commodities has arrived. So bottom line, we do believe that interest rates are heading toward that 5% level. We think that's going to usher in a new market regime of value over growth, in particular commodities. Maybe the banks, we're not there in size in the banks yet, but the banks would be another potential component here. But those are the areas that we're really focused on, including energy, of course. So the lid has come off those Japanese rates, sending a ripple throughout the interest rate market across the world. As interest rates move towards 5%, energy and metals, we think, are the key beneficiaries here. And then when we look at energies and metals, they really have started to break out in both an absolute and relative price perspective across the board here. So we like how things are positioned. We think we're starting to see that in terms of how the portfolios are acting. We like it. And we think this is the first inning in a multi-year cycle. So that's what we got for you this week, 888-543-3776. Please feel free to reach out to your advisor and have a great and fantastic week. Thank you.